Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, where we talk about trading, investing, options, and swing trading. So I'll share with you some insights here about calendar spreads. We're going to take a look at short-term duration versus longer-term duration calendar spreads as we get closer to releasing our calendar course, which should be released here in about 10 days or so. So I'll give you more insight here as we wrap up the sales page and the sales video, because that's pretty much all we have left to do. With that in mind, let's take a look here at the screen and look at some shorter term duration calendars and longer term duration calendars. So that way you kind of see, hey, when is it a good time to do shorter term duration or maybe longer term, and what's kind of the profit potential and so forth. So when we look at this, we are really looking at here a thinkorswim platform, and you kind of want to dictate things based on the VIX. So I'm going to pull this out a little bit just so you can kind of see it. Actually, let me just resort it. So if we look at the VIX right now, we're at 2520, which is very high. And what you have to remember is that calendars typically benefit when the VIX continues to go up. Now, looking at a 25 VIX, you're kind of at the upper range, right? So if we look at the VIX here, let's just look at our VIX, you can see that, hey, we've hit 35 in the past, but now we're heading lower. So it's probably still a better thing to do to trade maybe more iron condors, maybe something where you're short Vega because volatility will contract. And let's say it contracts to 13, putting on a calendar can hurt you in a big way. So instead, calendars do fantastic when you have kind of this upward trending VIX like we've had here since October. Now, when you normally go down in the VIX, it kind of hurts calendars. Doesn't mean you can't do them. It just means you need to be aware of the VIX problem. So here's kind of our VIX problem that we have. So let's go ahead and put something on, let's just say, let's take a look at Netflix here. And we'll go ahead. Typically, we put on calendars anywhere 30 to 40, 50 days out, but you can do it less, which is what we're going to talk about here in a minute. So let's say I go ahead and put a calendar at about 265. We'll buy a calendar. So we're doing the February, meaning selling, buying the March. We'll analyze the trade. And here's what this kind of looks like. So when we look at this trade right here, the amount of capital that we're using is about $275 to potentially make $1,300. So that's pretty good. Let me bump up some of the contracts. We'll go to about 5 contracts. Just that way we're using about $1,300 in capital. Now, you don't hold these things to expiration because they're a calendar spread anyway. With iron condors, you can let them expire. With these, you don't hold them till expiration. So let's say now we go ahead and we start moving forward. Normally, you would only hold these maybe around here, right? Maybe 10, 20% of the max. Right? So you have 80% still there left to go. So even if price went down 20, 30 points, you'd be out with $650 in profit, or maybe $900 in profit here. But you're using about $1,200 in cash, $1,300 in cash. So percentage-wise, that's pretty good, right? So when you look at that, about $800 on $1,300 investment, that's quite good. Now, the problem here that we have, of course, is the volatility. Now, if volatility, let's say, goes up 3 points, look at what happens to that tent. It expands, so we make more money. But let's just say it goes down 3 points. Well, now that compresses, right? So we lose money. But let's say it was 10 points. You go down 10 points. Well, now that profit starts to erode. Now, if it went up 10 volatility points, you make a fortune, right? So, but remember, we're at the upper range right now. So this is with a longer term duration calendar. Longer term meaning you're looking at your Vega to Theta ratio. So here, when I look at my ratio right now, we're starting out, and I have a Theta of 40 and a Vega of 49. So what this means is that it's almost a 1-to-1, right? So it's almost a kind of a 1-to-1 in a way. Now the February and the March, the difference in the days here, February 15 is 49, the March is 72 days out. So we have a pretty good date spread. But here's the problem is when you're starting out, let's say volatility drops 5 points, well, you're down $252, right? Because you've compressed it 5 times this 50 on the Vega, that's about $200 and some. So that's really what's happening. And how many days does it take to make up that 37, right? To make up that 252. And you're only getting 37 on the theta. So you got to go 1, 2, 3, 4, 5, 6, 7. 7 days to make it up with a 5 point drop in volatility. Now, if we go to a shorter term duration, let's say I go to a 9-day, and the next one I want to buy is maybe a 23-day out. So I'll do the same thing with a 9-day. So here's a buy a calendar, and my 23-day out, at least 2 weeks, right? So we're going about to January 25th. No, this one will be the 9-day. The January 25th is this one. Analyze the trade. So look at the difference here. We have a theta that's bigger than our Vega. So basically, you knock it out of the park, and it's quite a lot bigger. So again, let's bump up the contracts to about 5. So look at that, 59 to 47. Whereas the other one, we had 39 to 49. So the theta was smaller. So here, let's say we have a volatility point again, -5. Well, I'm down again $240, but how many days does it take to make it up? 1, 2, 3, 4. 4 days. Versus the other one, 4 days you're still down $96. 5, 6, 7, almost twice as long to make up that difference. Whereas here, if you held it, you'd already be up $480 some. Now, what's the disadvantage? Of course, there's no gimmies in the market. So let's reset this. Well, look at the width of this tent. The width of this tent is much shorter. You got about 250 to 280, right? And 5 contracts, you're paying more, $4,300 or so. Whereas this one, if you're worried about price, well, this one is much more cushiony, right? So if you're worried about price, you could go ahead and put these on, but volatility could be a problem. Now, in a shorter term duration calendar, when would you rather do this? Well, when you don't want volatility to be a problem. So if you think volatility is going to be a huge problem, it's better to put something shorter term duration because the theta kills your Vega. It's very strong. The theta is way stronger than your Vega. If you're worried more about price, well, you could put on something that's more longer term duration like this, where notice, hey, I could drop down 20, 40 points and I'm still okay, right? Because I'm still kind of in my tent, but you basically have a volatility problem here. So that's kind of the trade-off is that, hey, if I go shorter term duration, well, I have a bigger theta, I can make more on a percentage terms, but you got a pricing problem. If you go longer term duration like this one, 30, 40, 50 days or so, then you have less of a price problem, less of a delta problem, but more of a Vega problem because of the Vega issue here that you have. So that's kind of the trade-off. It's not that one is better than the other. It's just looking at market conditions. What are you kind of looking at that could be a problem? With a high VIX, you probably want to watch out for, things like the volatilities, because the volatilities could compress very quickly. But with a high volatility, you also have price that moves. So usually shorter term duration is more favored because you don't want that volatility to be too large or have a major problem with volatilities when you're doing calendar spreads, especially with a VIX over 20 to do 2-directional risk trade problems is a little tough. So, so you definitely want to just, capture that theta as quick as possible, see if you can hold that trade 1, 2, 3 days. Say you held it 2, 3 days and you're out. Whereas a 30-day trade, 40-day trade, you might need to be in that trade 10, 15 days. This one, 2, 3 days and you might be out. So that's kind of the advantage here is that when you go shorter term duration, you can be in and out pretty quickly. So if price just holds steady for just a little bit, you're okay. So anyways, I hope this makes a little bit more sense. And if you're interested in learning more about calendars, we have an upcoming course that's really in-depth, many hours of going into trade examples, strategies, and even looking at paper and on screen of really different ways to look at calendars, manage calendars, adjust calendars, the risks involved with them, and how to set those trades up. So if you're interested in that, be sure to get on our newsletter list by clicking the link over here or under this video, and we'll send you more details as they come up. It'll be coming out within that next 10, 12, 15 days, the next couple weeks, as soon as we wrap up kind of the sales video and the sales page. So that's pretty much all there is that's left. So if you're interested in this course, get on the newsletter list and you'll be notified as soon as it's released. Thanks for joining me in this week's video. I hope you had a wonderful holiday break. Happy New Year to you, and I wish you a great, successful, and happy 2019 ahead. I'll see you next time.